Welcome to the TAC Index AI podcast, Weekend Edition, where we blend TAC IP data, reports, and charts with the latest news and all things logistics, especially focusing on air cargo. This week, we're doing a deep dive into your sources from September 4th through the 6th. Our mission really is to cut through the noise, pull out the key nuggets, and help you understand this intricate dance between air cargo, jet fuel prices, and, the broader macro currents. In a world where supply chains are constantly being reshaped, we're asking, are we seeing a market finding its footing or maybe entering a new era of unpredictable, localized volatility? Let's unpack it.
Indeed, that's really the core question, isn't it? What's truly fascinating here is how events that seem pretty separate, like airline labor talks or, a country's fuel buying strategy, how they can actually converge and send ripples right through global logistics. So we'll explore these immediate changes, maybe what they signal for the weeks, perhaps months ahead, to give you a clearer picture of where things really stand.
Okay, let's start by digging into this week's air cargo market. This is based on the latest data from the TAC Index, published September 3rd, but covering the week leading up to September 1st. Globally, air freight prices did edge a bit higher. The overall Baltic Air Freight Index, the BII Other, that's kind of the benchmark global index, gives us that vital pulse. It gained a notable plus 2.6% week on week. But, and here's the crucial context, it's still down managed 5.9% over the last 12 months. So we're seeing this little short-term bump, but it's still against that longer-term trend of, let's say, recalibration.
Yeah, and that immediately raises a key question. What's genuinely driving this weekly gain? And why is the year-on-year figure still negative? It really suggests a market that's far from settled, experiencing these specific pockets of strength, but within an overall rebalancing phase. The details from the individual lanes, they really illustrate this mixed picture. It points to some very localized dynamics, things that the global averages can often mask.
Absolutely, and this is where it gets particularly insightful, I think. Let's look at some specifics, because the story isn't uniform at all. Rates out of China, they rose week on week, both to Europe and to the U.S., and it's worth noting there was a firm tone on that new lane to Mexico, too. For instance, the outbound index from Hong Kong, BAI 30, that tracks rates leaving Hong Kong, it edged up plus 1.4% week on week, while Shanghai's outbound index, the BAI 80, saw an even stronger gain, plus 3.6%. Then, on the other side of the world, London Heathrow, BAI 40, tracking outbound from the UK. Well, it absolutely surged, gained plus 11.6% week on week, which pushed its year-on-year gain to an impressive plus 18.3%. Chicago, BAI 50, also registered a big gain, plus 11.1% week on week. It's a real tale of concentrated growth in specific areas.
Right. What's truly fascinating here is that concentration of strength in certain key outbound hubs. London Heathrow surge, for example. Well, it could suggest pretty robust demand from that region, maybe reflecting specific European market needs or perhaps even some strategic inventory buildups. It's hard to say for sure just from this. These regional hotspots, along with that firm tone on new lanes, Mexico, Australia, Brazil, Seoul, they seem to indicate a dynamic reshuffling of supply chains. It feels like it's not just about adapting to new demand patterns, it's maybe a more fundamental reevaluation of trade flows, something we saw hints of in the August update. This fragmentation, it isn't just market noise, I think. It suggests that global logistics providers, well, they can't really rely on broad market trends anymore. Success now might hinge on hyper-localized strategy and dynamic rerouting.
That's a compelling read on that concentrated strength. But then, looking at Frankfurt's fall and say, Vietnam's mixed results. Does that suggest these hotspots are maybe more like temporary market aberrations, rather than a true underlying healthy shift across the board? Because rates from other regions were definitely more mixed, right? It reinforces that this isn't some universal uplift. Vietnam saw falls to Europe, only slight gains to the U.S. Bangkok was higher to Europe, but lower to the U.S. Seoul and Taiwan are mostly down. Even Frankfurt, BAI 20, tracking outbound from Germany, it fell overall by 6.6% week on week. That's significant. And then there's India. Rates were higher to the U.S. despite those announced higher tariffs, but lower to Europe. This really paints a picture of a complex, almost fragmented market, doesn't it?
It absolutely does. And if we connect this to the bigger picture, the varied performance just underlines the segmented nature of the air freight market. The India situation is particularly noteworthy. Despite those significant tariff headwinds, underlying demand or maybe specific product flows to the U.S. remain remarkably strong, perhaps even at the expense of European routes. It kind of challenges the conventional wisdom that tariffs just immediately stifle trade. It suggests that for certain goods, maybe critical supply chains, the imperative to move the product outweighs the added cost. This complexity means you really can't generalize from global averages alone. You need to look at specific lanes, specific regions to understand the true market health and direction. It's less like a tide lifting all boats and maybe more like individual currents pushing and pulling in different directions.
That's a crucial insight, the idea that demand can sometimes defy tariffs. Okay, let's shift gears now to a critical factor for logistics, the price of fuel. On September 3rd, oil futures gave back some earlier gains. WTI, the U.S. benchmark, settled down 2.5% at $63.97 a barrel. And Brent, the international standard, it fell 2.2% to $67.60. This was as the market was looking ahead to that OPEC Plus meeting on Sunday. There was a Reuters report citing unnamed sources suggesting members might consider unwinding more output cuts.
All right, so a key query emerges here. Will OPEC Plus actually increase output? There seems to be a strong debate. Well, some sources suggest they might unwind about, was it 1.65 million barrels a day? Others, like Phil Flynn at Price Futures Group, argue they'd be, quote, crazy not to at least talk about it, given how tight supply is and the risks involved. However, you have analysts like Alex Kupskevich at FX Pro pointing out a crucial constraint. Countries like Russia and Iran, they face sales restrictions, equipment limitations. It makes it hard for them to just ramp up production easily, even if an agreement is reached. This suggests that even if there's an agreement to increase, practical implementation might be constrained, which, could keep prices from falling too sharply or for too long.
Okay, but then this India announcement on Russian oil feels incredibly significant, linking directly back to what you just said about Russia. On September 5th, India's finance minister announced India will continue buying Russian oil because, well, it's economical. This is despite the U.S. imposing that 50% tariff on Indian goods, partly because of these energy purchases. This feels like more than just an economic decision, doesn't it? It's got strong geopolitical undercurrents.
Well, actually, it's a pivotal development, really, for global energy markets and trade relations. India, as the world's third biggest oil importer and consumer, has strategically taken advantage of discounts on Russian oil. They became the largest buyer of Russian seaborne crude since the 2022 invasion of Ukraine. And the U.S. response was quite direct. Commerce Secretary Howard Lutnick urged India to stop, support the dollar, even predicted India would come back in 1 or 2 months, apologize to Trump and seek a trade deal. Strong words. The situation gets even more complex with Prime Minister Modi joining Putin and Xi Jinping at a summit in Tianjin this week, a gathering some observers dubbed the Axis of Upheaval. So this move by India, prioritizing its energy security and economic needs, it's clearly drawn a sharp reaction from the U.S. Treasury Secretary. Scott Bessent even accused India of profiteering by reselling refined Russian fuel. Look, this isn't just about oil anymore. It's about shifting alliances and economic leverage on a global scale.
So the ripples from this oil volatility clearly hit jet fuel, operational costs for airlines, and air cargo. But it's not just the price of fuel shaping things, right? It's also about capacity. Are there enough planes, enough staff? Which brings us naturally to capacity. On September 3rd, a Reuters report revealed that new orders for U.S. manufactured goods fell in July, pulled down significantly by a staggering 32.7% drop in commercial aircraft bookings. That seems like a huge number impacting future capacity, doesn't it?
It really is huge. And it raises an important question about future air cargo capacity down the line. Commercial aircraft, they provide a lot of that belly-hold cargo space. So a sustained decline in bookings for new planes could, over the long term, reduce the rate at which new capacity enters the market. Or if older planes are retired and not replaced at the same rate, it could even signal a future contraction in available cargo space. That could potentially make air freight more constrained, maybe more expensive down the line. It's definitely a leading indicator, something to watch for what the air cargo landscape might look like years from now.
And in the shorter term, there's another capacity-related development that could cause, immediate ripples. On September 6th, Air Canada flight attendants wrapped up voting on a wage agreement. Reports suggest, more than a few crew members don't expect the tentative deal to be approved. This could lead to a very tangible, immediate impact on services, right?
Precisely. If we connect this to the bigger picture, the potential non-approval of that wage agreement could swiftly lead to labor actions, strikes, work slowdowns. That would directly impact Air Canada's flight schedules, which immediately affects both passenger and belly-hold cargo capacity on routes they serve. That causes disruptions for shippers who rely on those services. It's a very real risk that could impact many supply chains, especially for time-sensitive cargo. It just underscores how deeply interwoven labor relations are with the practicalities of logistics.
Okay, switching back to trade policy for a moment, President Trump signed an executive order on September 5th. It offers some tariff exemptions to trading partners who strike deals on industrial exports. These exemptions are set to start Monday, September 8th. They cover things like nickel, gold, pharma compounds, chemicals, some ag products, and significantly for us, aircraft and parts. This sounds like a strategic move to maybe realign trade, especially when we think about those falling aircraft bookings we just mentioned.
Yeah, what's truly fascinating here is how this policy seems aimed at strategically realigning trade. The exemptions are specifically for goods that cannot be grown, mined, or naturally produced in the United States or, not in sufficient volume. So removing tariffs on aircraft and parts could potentially lower costs for airlines and manufacturers, which indirectly supports the air cargo sector by reducing operational overhead or manufacturing costs within those aligned trade relationships. And it contrasts so sharply with that 50% tariff India is facing from the U.S., doesn't it? Such strategic use of tariffs and exemptions, it directly influences global supply chains. It affects where goods are sourced, where they're manufactured, and ultimately how they get transported air or sea. It signals a deliberate shift, maybe, in the landscape for how goods move internationally, rewarding certain trade relationships, penalizing others. It adds another layer to our central question of, stability versus flux.
Okay, let's zoom out now to the broader macroeconomic environment. On September 3rd, tech stocks were back on top. They drove gains in the S&P 500, up 0.5%, Nasdaq up 1%. Shares like Google, Apple, Dell leading the charge. However, the Dow Jones Industrials closed slightly lower, weighed down by sliding oil stocks, which fell 2.3%. It sounds like a bit of a mixed bag, indicating different forces at play.
That rotation within the equity market is quite telling, I think. While tech strength might indicate confidence in specific growth sectors may be driven by innovation or perceived stability in those companies, the decline in energy shares, well, that directly reflects the uncertainty we were just talking about in the oil market. It highlights that the economy is definitely experiencing different forces simultaneously. We also saw gold prices trudging higher, closing at a record $3,593.20 per troy ounce. That suggests investors are also looking for safer havens amidst the volatility and maybe broader market jitters. It points to a kind of cautious optimism, maybe, where growth is sought, but risk aversion is still very much present, reflecting that global uncertainty.
And beyond the daily market swings, there were also key economic data points mentioned that could shape future market direction. A crucial jobs report was due this Friday, September 5th. Plus, upcoming inflation readings and an anticipated Federal Reserve meeting that investors seem to expect will deliver a much-awaited interest rate cut. These are all potentially huge for market sentiment and ultimately for the demand side of logistics.
Absolutely. If we connect this to the bigger picture, these macroeconomic indicators are fundamental. A strong jobs report, significant shifts in inflation, or an interest rate cut from the Fed, these can profoundly impact consumer spending, manufacturing output, business investment. And those, in turn, directly influence the demand for all forms of logistics, including air cargo. The strength we saw in small-cap stocks, the Russell 2000 rose 7% in August, suggests investors might also be looking for value beyond those high-flying tech giants. Could be a potential signal of a broadening recovery, but one still navigating, as one analyst put it, a gauntlet of challenging economic data. The market seems to be trying to find its footing amid these conflicting signals, making that question of stability versus flux even more pertinent right now.
Wow. What a week of really intertwined developments. From those nuanced, often quite fragmented shifts in global air freight prices, to the geopolitical chess game around oil, to capacity concerns both long-term and immediate, and that strategic use of tariffs reshaping trade. It's just a powerful reminder of how interconnected everything is, isn't it? And how quickly one event can ripple through the entire logistics ecosystem. This isn't just a collection of news items. It feels like a dynamic narrative of global systems under constant reevaluation.
Indeed. These updates really underscore that understanding logistics today means grappling with this complex web of economic, political, and operational factors. Every decision, from a tariff exemption to an airline labor vote, has a ripple effect. It touches every part of the global supply chain, and ultimately it touches you as a consumer or a business. It emphasizes that while the future of logistics might be less about broad, predictable trends, it's increasingly about pinpointing and adapting to these rapidly forming microcurrents.
So, as supply chains continue to reshuffle, and with all these unpredictable forces we've discussed at play, what single variable do you think will prove to be the most disruptive, or maybe the most defining force shaping air cargo in the coming months? We invite you to consider that thought.